Hey, this is Bubble Analytics, and this week we are developing a new strategy around what we're calling the ADL ulcer indicator, and it takes two inputs. One is a breadth measure called the accumulation distribution line, which combines price movement with volume. And the second is the ulcer index, which measures a downside risk. So effectively it's looking at the depth and the strength of a drawdown from a maximum value from the most recent highs. What we're going to be doing today is taking our breadth measure, the accumulation distribution line, and creating the indicator, the ulcer index, from that data. And then we're going to be using it to create a trading strategy. So for our breadth measure, effectively what it does is create something that will track money flow volume. What it does is it takes the price action and convert that to a range between -1 and +1 and tracks where price closes within that range, and then multiplies it by the volume and then creates a cumulative sum from that. And then our ulcer index measures drawdown risk effectively over, we're going to use a 14 period window, and that creates the indicator you see in red. So our strategy today is to buy whenever our ulcer ADL indicator turns higher, and we're going to sell whenever it crosses below zero. So the idea of this one then is to buy pullbacks using the ulcer index when breadth starts to turn positive, and then get out of the market every time our ulcer ADL turns below zero. So that's our risk off trigger. So if you're ready to start coding that up, please read the disclaimer. Okay, let's get going then, and I've opened up a fresh Jupyter notebook, which I am going to rename ADL Ulcer, and I'm just going to click in the first cell here, click Shift Return a few times just to create some empty cells. And to save time today, we'll be copying from our template here. This contains repeatable code snippets that we use each time to create a strategy and then backtest it. Both the completed notebook that we make today plus the template will be available to download for free. You can get that on our website, www.bubble-analytics.com. Link is in the footer here in our GitHub profile. So let's get going then. And first job, as always, would be to import our libraries. These are our helper libraries that are going to help us to run our strategy and then backtest it. So I'm just going to hit Shift Return a couple of times to initialize that in our notebook. And next job would be to grab some price data. So we're going to download some historical market data from Yahoo Finance. We're going to do that using the Y Finance library here, which we imported as YF. If I paste that code snippet in and hit Shift Return, this is the output that you should expect to see. The key line is the one right at the top. So if I just comment these lines out. So we're going to use the Y Finance library, which we imported as YF here, using their download method. And that takes a minimum of 3 parameters. So you need to tell it the ticker, the period of time you want the data for, and then the time frame. So in our case, we're going to download 10 years worth of daily time frame data for QQQ, the Nasdaq 100 ETF. And we're going to store it in a variable called df. So if you want to see what's in df, just type the variable name and click Shift Return. And this is the output in raw format. And effectively, these lines just tidy it up a little bit. So first line there is going to get rid of the superfluous column names. We don't need a multi-header column here. So if I just uncomment that out and run that line, you can see it gets rid of that ticker and then QQQ across the top. Next job, we're going to split price and date into their own columns. To do that, we're going to reset the index, which will have the effect of making price the index with the row numbers on the left hand side here. Next line looks at the date column. And even though the date in the dates in the date column look like actual dates. They're actually number strings. So if you wanted to use date in a date format within your code book at some point, as we will do when we create the x-axis on our chart and display month and year, you need to convert that to a date time format. So that's what this line does here. So it takes the date column, uses pandas library, which we imported here as PD, and uses their toDateTime method to convert that to a datetime format. And then finally, because we're going to need the volume today, I'm just going to delete this line completely, and this is now your data set, and this is what we'll be using going forward. So let's start with our first breadth measure. This is the accumulation distribution line. I've come into Stock Charts Chart School here, where you can get a good explanation of what it is and how it works. It is effectively this pink line here on their chart, and what it does is it combines price action and volume effectively to create a breadth measure that is designed to show you if the rally or the decline that you're seeing there is being fully participated in by the majority of stocks. And it comes up with a little example here. I'm not sure it actually sort of really tells you this, but so if you look at the price action coming down here into this low and then the little rally, you can see that the accumulation distribution line follows it quite well. So falls when price is falling, bottoms out when price bottoms out, and starts to rally. But if you notice here, it turns over prior to the top being made with price. And it kind of serves as a warning, as most breadth measures do, that perhaps the underlying strength of that rally is not as strong as people would believe, or sort of warns you that there's potential for an imminent top. So they call that divergences, and divergences are not always that reliable in my opinion, and certainly I don't think you could create a strategy around it, but let's get this one created then. So it's quite simple. What it does is it creates something called the money flow multiplier through this line here, and what that does is create a range between +1 and -1, and of course it then tracks where the close is relative to that range. So obviously the close higher to +1 as possible is the most bullish. So if it closes at 0.9, that's the most bullish. And then effectively we take that money flow multiplier and multiply it by the volume for that period. And then the ADL is effectively just the cumulative sum of money flow volume. So let's get this created. So I'm going to define a function called ADL. And ADL, we don't need to give it a look back period or anything like that. We just need to tell it where to find our data. So ADL, if I copy, I'll tell you what, let me just copy that from there. And what we'll do is bring it in. I do that. Bring it in and copy that in there. So effectively we're looking at the money flow multiplier, so we need to tell it where to find the OHLC data for this line and the volume, and that's it. So we don't need a look back period or anything like that for this one. So let's do the money flow multiplier. I'm just going to call that MFM, and that is equal to data close minus the low. So we're going to need some brackets, aren't we, in a minute? In fact, we'll do that now. So we want the close minus the low, and from that we deduct the high minus the close. So in fact, I am going to just copy this like that twice. So this one, so it is the close minus the low minus the high minus the close. And then that is divided by the high minus the low. And then we should make some more brackets here, I think. So this whole thing needs to go in one giant bracket. So that's your money flow multiplier. So that's what creates the range. And then for the money flow volume, which I'm just going to call MFV here, it is basically just the calculation above, MFM times the volume. So let's get that in there. And then our ADL then is effectively the cumulative sum of money flow volume. So if I do MFV, and then what we're going to use is the CumSum method, so cumulative sum method. And from our whole function here, all we're looking to do is return the value of ADL. So now we're going to create I can delete this now, can't I? So now we're going to create a new column in our data frame DF. So call the name, tell it what we want to call the column, which is going to be ADL. And that is going to be the equivalent of running our function and then telling it where to find the OHLC data. And if I now hit shift return to run all that, you should see that we've got values in our newly created ADL column within our existing data frame. So that's that done. Let's now, should we do that? No, I'll tell you what, we'll create the chart first. It'll be easier to understand. So we're going to recreate this chart for stock charts, and it is going, we're not going to display this volume thing part at the bottom here. We're just going to have the accumulation distribution line and price above. So on this chart here, we're going to use Plotly, and this is all effectively one lot big column, this chart. With two rows. So prices on row 1 here above, and the accumulation distribution line on row 2. So let's go and create that now. So to do that, I'm back in my template here. This is the chart section, and what we're going to need to do is make a subplot. So we're going to tell Plotly to make a subplot. So that's price with an indicator below. And in here, we're telling it we've got one column with two rows. We're going to share the x-axis, and then the row heights here dictate how much sort of chart real estate price gets versus the indicator. So in this case, row 1 price data is getting 68%, and the indicator below is 32%. So I'm going to grab all this section here, including the couple of lines above, and going to come back and leave a few empty spaces here because we're going to create another indicator and our signal function. So that's that part. This section here above, what we're telling Plotly to do is split the data. So effectively, if I didn't have these lines in here or comment them out, every time we ran the chart and rendered it, it would show all 2,514 rows. And we don't want that. What we want to do is take a slice of our data, which is what this part does here. And effectively, you tell it what row number or bar to start from, and then how many bars after that you want to display. So you could start from bar 1,000 and display 500 bars, for example, or as in my case, what I normally do is take sort of anything around 300 plus, so 350 here, and then what I'll do is make that 2200. So effectively we would end up with 314 bars on that one. So that is the first part of it here, and we've set up our subplots and then imported price. So this is importing our OHLC data here, and then styling it up color-wise, and then we're putting that on row 1. So for row 2, what we're going to do is feed it in the values in this ADL column that we've just created. So if I come back in the template here, and what we're going to do is add some indicator data to our indicator subplot here. So I'm going to take this code snippet and I'm going to paste that in. And all we need to tell it is what the column name is that we're looking to take the data from. In that case, that is ADL. So, and then you're just styling it up really. So I'll leave the color as it is, I think, but I tend to make the width a bit wider, a bit chunkier. And then this is for the price label on the right hand side, so where you get the chart legend. So I'm going to change the name of it to ADL, and this will be on row 2. So column 1, row 2 for this one. And so with that in place, that's more or less what we need. We're going to render it. So all the bits at the bottom here really is you styling up your chart. So I'm going to take this whole little section here and going to start to play with this a little bit. So first little code snippet here, all it does is set the width and height of your chart, gets rid of an annoying little range slider, and then sets the theme. So I've gone for the dark theme, and then I've updated the grid color only because it stands out quite a bit on the, you can get rid of this, but it stands out quite a bit on the the existing theme colors. And then down here, if you want to save your image, your chart image, you can save a copy to wherever you have your codebook saved. I'm not going to do that today, but you would just rename it there, and leave that code in and run it. And then this is probably the only sort of keyish bit here, is that we want to update our x-axis so that it displays the date. So at the moment, what it would display would be the row numbers, because the index is price here in this column. So what we're going to do is change it to the date, and this is why we converted the date to a date time format originally, is so that Plotly can now render a date at the bottom. So in order to do that, or do that a bit better than sort of standard here, we are going to create some range breaks, basically. So we're going to tell Plotly what part of the data we want to include. So with stock market data, typically you've got Monday to Friday minus bank holidays. So, but you don't have any data on a Saturday and Sunday. Plotly doesn't understand it's rendering stock market data, so it is going to render Saturday and Sundays, which means you're going to get gaps in your chart. So in order to avoid the gaps and make it a little bit smoother, what we are going to say is, I'm just going to get rid of this line here, what we're going to say is create a range break that starts on Saturday and ends by Monday. So effectively we get rid of Saturday and Sunday. And then finally, in order to visualize the date on the x-axis, we're going to have to set the date column as the index. I'm just going to take this line up here and come back in, put that above. And then if we run all this a couple of times, let's have a look. Okay, so now we've got our chart formed. We're displaying the most recent bars, and we have our accumulation distribution line here below. And you can see that it more or less follows price, but this is kind of what I mean about divergences. So if you notice here, price makes a high in sort of late October and then doesn't make a new high until April. It starts to break out in sort of mid-April. This is like kind of a double top. But if you notice on the breadth measure here, we made a high as normal, and then we carry on making highs, and we even make a really nice new high here, way above this one. So the breadth measure was making a new high, even though price wasn't, and that's kind of considered a bullish omen. It sort of says that maybe the sort of strength of the decline is not as bad as you think, and you know, it may be good, even though we start to pull back here. But that's the kind of thing people would use it for and look for. We're not going to do that today. We tend to find that breadth measures are much better when combined with indicators, to be honest. So next job then, it would be to create our second indicator, and that's going to be the Ulcer index. And the Ulcer index is really good. It's basically tracking sort of the speed and strength of a decline from a most recent high. So again, read the article by Stock Charts. It explains it much better than I'll be able to. But effectively, it's looking at the close minus the highest close within a certain period, so your look back period. It creates kind of like rate of change effectively, and then it creates a squared average, which is like it says, the 14 period sum of this percent drawdown squared, and then takes the square root of that squared average. It sounds a lot more complicated than it is, but effectively it is basically measuring downside risk, downside volatility. So the only change we're going to make to it here is that whereas the standard indicator is going to use the price close, we're going to swap the price close for that ADL, our breadth measure. And the other thing we're going to do is flip it. So, and this is just my taste, but the Ulcer index here falls when price is rising, and it rises when price falls. And that's annoying and a bit counterintuitive. So we're going to just change that. So basically when price is rising, the Ulcer indexes as well, so on and so forth. So that's the only change we're going to make there. If you want to go and get a spreadsheet, they provide a spreadsheet for you as well, so you could go in and have a look at the formulas. But this is how you do it. So in fact, let me copy all that. And what we'll do is define a new function then called Ulcer. And Ulcer, all that's going to take in is some data. So we need to tell it what would, where to find the closing prices of the standard indicator, but in our case, the ADL. And then also the look back periods, which is just going to be called N here. And then, so let me paste that in. So the first thing we're going to create is the percent drawdown, which I'm just going to call PD. And that would be equal to the ADL data that we just created. So current value of ADL minus the highest value within that look back period. So that would be data ADL, and then we're going to create a rolling window. So chain on the rolling method here, which would be equivalent to n. N is going to be 14, but could be any look back period, or n is the look back period for us, from which we're going to take the maximum value. So we're going to create a rolling window of these values, from which we're going to take the highest and store that. So it's the current value minus the highest within that look back period, divided by the highest within that look back period. So if I just grab this here and paste that in, and then the whole thing is times by 100. So that's our first line done, and we're going to need some brackets, aren't we? So we can just follow the example here. So we're going to need 2 in there, 1 in here, and another 1 in here. So that's our first line done. Now it's the squared average, and this is the square of the 14 period sum of percent drawdown. So we'll call it SA for squared average. And so that would be equal to the value that we just created above PD, and then which we're going to square just like that. And from that, we're just going to take our rolling n for our look back period average, so our mean. So relatively straightforward. And then our ulcer index then is effectively the square root of our squared average. And for that, we're going to be using the NumPy library, which you imported here as NP. So where you see NP, that's NumPy. So UI then is going to be equal to the squared average above, to which we're going to apply NumPy's square root method. So, which I think is that. And then from that function, we just want to return the UI values. So we're just looking for our ulcer index values. So effectively, we've created the ulcer index, but on our breadth measure. So just like we did above, we're going to create a new column with these values in. So I'm just going to call that UI, and that would be equal to run our function, call our function here, tell it where to find the data, which is in DF, and the look back period we want to use, which we've picked 14. So that is that. Let me now run it, and you can see we've created our new columns and we have our new values. And what I'm going to do is, because we've got some none values here, not a number values, I'm just going to get rid of those. The reason that you have them is that at this point in the data set, you don't have enough values to compute this rolling average. So we're going to use the drop NA method to get rid of it. So we call our data frame here DF, and then hit drop NA and tell it to do it on the existing data frame. So df.drop NA. And then, like I said before, I don't like I think it's counterintuitive when you see an indicator that falls when price rises and so on and so forth. So we're just going to change it. So effectively, I'm going to take the UI column here, and that would be equal to 1 minus the value in the UI column, effectively. So what that'll do is invert it, so now it rises when price rises, vice versa. So if we now run all this, you should see now we've got values, no non-values here, and we've still got values in our column. So, right, let's go and put this on a chart. So we shouldn't really need to go back into our template for this, or to at least to load the price data, but we're going to have to amend our existing chart here. So if you notice that we only created 2 subplots within the one column. So now we're going to have 3, because we're going to add in the ulcer ADL indicator. So change that to 3, and then I'm going to have to tell it what percentage each gets. So I'm going to change the price is going to get 50%, and the indicators are going to get 25% each. So that's 50.25.25 there. And then we can copy this whole little code snippet here and paste that below. And what we're going to do is add the values in our UI column here. So I'm going to change that to UI and then change the name of it to also ADL, I guess. And then we will make that, because it's measuring drawdown risk, we'll make that red. And then obviously that's going to go in row 3. So if I run that whole thing again, shift return to run it, you can see now we've got our breadth measure above and our ulcer index below. So we're going to tart it up a little bit. First thing I'm going to do is make because I've got 2 indicators there, I'm just going to make the chart height a bit higher. So we'll make that 900 just so that we get more of a nice view of it, and then we're going to tart it up a little bit. So first thing I'm going to do is add some horizontal lines for the ulcer index. I just think, I don't know, I tend to find that helpful. So what we'll do is we'll grab some H lines we're going to create. So we're going to add levels lines to our indicator. So we're going to create horizontal lines effectively. So I'm going to grab this little code snippet here. And then if I look at my chart, I'm going to have one at 1, -1, and -2. You get one automatically at 0 level anyway. So I'll come in and paste that in. We're going to create 3 lines. So I'm going to hit this 3 times. And then we're going to have to make these appear in row 3. So I'm going to amend that to there. And we're going to have one at -2. And then we're going to have one at -1. And then finally, we're going to have one at 1. So, and again, if I now hit shift return to run that, we've got now, that to me looks better. And then let's chain on some, chain on some labels just so that we know what we are doing, what indicators which sort of thing. So this part here, the subplot title, and then I'll show you how to chain it. So we're going to come and grab this little code snippet here from the template. Come back above, and so the first one I'm going to do is the ulcer ADL, and the key line with this is styling it up so white and size 13 in the text that you want to put it, and then this is the sort of key part of it for this little code snippet is the xref and yref is paper, and what that's saying is create a grid coordinates sort of square over my chart, and effectively it's creating a sort of a 1-to-1 coordinate base or 0-to-1 coordinate base. So for the y-axis, so down to up would be 0 to 1, and for the x-axis, left to right would be 0 to 1. So effectively, when I say plot my label at x equals 1, I'm saying plot it as far right as it can go on the chart. And then for my y value at 0.2, I'm saying plot it 20% up from the bottom here. So if I just run this now, it should give me an idea of where that label is going to... Okay, so we're not far off. So it ended up here, and we're just going to move it up slightly by changing the y value. So if I change that to... Let's try that. Well, it's still a bit tight, isn't it? So let's try that 0.24, probably a bit high, but there you go. So if I changed my x value now to 0 and ran that again, you would see that it would be over here on the left-hand side. So I don't know whether I might keep that actually. So anyway, so if you want to chain on a secondary label, you can't have multiple versions of this code snippet on their own. You need to chain them together. So otherwise they usurp each other. So we're going to copy from the dict part here. So effectively I'm going to take it from that dict part all the way down to this first bracket at the end. And then I'm going to copy that code snippet there and put a little comma and hit return to make some space and then paste that in. And I'm going to then change our label to accumulation distribution line. I'll spell that right, maybe. And then we're going to, all we need to do is effectively move it up on the screen a little bit. So if I kept that the same and run it, you would have 2 labels overlapping. We're going to move it up to here a little bit. And that is about 50% higher, isn't it? Maybe a little bit more. So we'll make that, say, 52. And then if I run that again, there we go. So we've got labels for each on our chart. And yeah, looking quite good. So next step then would be to get our signal function in place. So I'm going to come back into my template here and then grab this function. So all this function does is run through your data set, or whatever data set you tell it to run through, line by line, looking for your buy and sell parameters to be hit. And where it sees a buy signal, it puts a 1 in the signal column. Where it sees a 2, where it sees a sell signal, it puts a 2. And where there's no signal, it has a 0. And then it creates a column within your existing data set called signal. And this is what's going to tell backtesting when to buy and when to sell. So let's get this set up then. So for our buy signals, all we're going to be doing is looking at when our ultra-radial indicator turns up. So there's a big loop there. In fact, let's go and have a look at that. So I think there'll be a sell signal as well. And for our sell signal is the ultra-radial dropping below 1, which it does there, yeah. So for our sell signal, effectively, we're going to be saying if yesterday's value of ultra-radial was above 1 and today's value is below 1, as it is here on March 16th, 17th, that would be a sell signal. And then for a buy signal, all we're looking is for a turn higher. So you can see here on, yeah, I think that's it, isn't it? So April the 6th to April the 7th, that's where the turn comes. So April the 7th is higher than April the 6th. But April the 6th was lower than April the 2nd. Yeah. So effectively that's charting the turn, isn't it? So, and then to do that, we're going to use the iLock method. iLock for our signal function, I is representative of the current bar. And then I-1 is the bar before, I-2, 2 bars before current, I-3, 3 bars before current, so on and so forth. So where you see .ilock, I-1, it's yesterday's bar, so on. Anyway, let's go and code this one up. So the sell signal is really simple. So all we're saying is data.ui.ilock. So if yesterday's bar, so which would be I-1 here, is greater than 0, and today's value for UI.ilock, and today's value is then .ilock I. Today's value is greater than 0. Less than 0. What am I doing? That would be our sell signal. So effectively, if yesterday's value of UI is above 0, today's value is below 0, that's our sell signal. We get out the market. And then for our buy signal, we're charting the turn. So what we're effectively saying is today's value of UI, so that would be .ilock I, would need to be greater than yesterday's value, data.ui.ilock I-1, and the value yesterday, so data.ui.ilock I-1, would need to have been less than the day before that, so data.ui.ilock I-2, if that makes sense. So, and let's run our signal function. Oh, what have I done? Oh yeah. Need one of those. I think that's okay. Yeah, there we go. So now we've got a signal column within our data set, and this is what, let me run all that again, because notice how when we get to this point here, we're setting the date as the index. So if you then go back and make an amendment to your data set, it puts price and date back into overlapping headers. But anyway, so signal column is there, and let's now render the buy and sell signals on our chart. Just make sure the actual methodology is working. So if I come back in the template into the chart section, see this little bit for entries. Actually, before I need to do this, don't I? So come back in the chart section, this little section above here, long entries and short entries. Let's grab that and we'll paste that in here. So all this is doing is running through the data set DF, and it's looking for the values in the signal column. And where it sees a 1, which is a buy signal, it returns the value of the low price minus a small offset. And where it sees signal equals 2, it returns the value of the high column plus a small offset. And then these lines here create two new columns, one for long entries, one for short entries within our data frame. And effectively, we record those prices where we get the signals at, or we have a NaN value instead. And the prices within those columns are what Plotly is going to use to place the markers on the chart effectively. So if I run that, and then we have definitely made a mistake here because so data.ui.I. Oh, there. That needs to be I-2. So when I ran that, if you see this line here, it gives me the value counts in the signal column. And if you notice there was no buy signals. So all it gave you was 0 signals and sell signals, 2, but no buy signals. So obviously there was some error in my code above, and that's what sort of prompted me to go up and have a look. So basically I mislabeled that. So if I now run this and then run the next column again, next code cell again, you can see that now we've got our buy signals in place. So 195 buy signals, 39 sell signals, and now we're going to render those on the chart. So if I come back into my template here and grab the chart section, the entry section for the chart part, and I am going to, let's just whack that in there. And if I now run that, we should get buy and sell signals rendered here. So for these little code snippets here, all they're doing, don't forget that we just created two new, in fact, let me just call it, I can't do that on that line, can you? Dang it. Let me call that here. So if I run it all again, you can see that we've got two new columns within our data frame, long entries and short entries. And then, so what Plotly's doing here is it's looking in that column and where it sees a price or where it sees an entry. So it's basically going to be a price or a NaN value here. So it's looking in those columns where it sees an entry, it creates a marker, and then this part styles it up. So we are telling it to make it size 7, and for a buy signal, it's a white arrow up. And then on the short side, looks in the short entries column, creates a marker where it sees a price, and it's going to be a gold cross with a size of 7, and that looks like this on the chart here. So let's go and have a look. If you remember how we were looking for a turn here, so we crossed down on March the 17th. There you go, there's our sell signal working. And then for our turn up, it was April the 7th, I think. And there you go, there's our long entry working as well. So that's that part done then. So we kind of know that our signal function, or we think what we've asked it to do is working. Now that we've got a signal column in place, we can create a backtest. So let's go back into the template, and I'm going to take this whole section here. So this is the backtesting script, and we're going to amend it slightly, but effectively this is where we tell backtesting what to do where we get a 1 or a 2 in our signal column. So first part of the code here, we take in the value. That's a function to take in the value of our signal column. And then we create a strategy class called myStrat, initialize it here, and then bring in the signal value using that signal function that we just created there. And so where you see self.signal, that's referring to the values in that column. And then these are the main bits here. So where self.signal is 1, so a buy signal, if we're already short, we close that position. Or if we don't already have a position, we open one and we buy with a size of 99% of available capital. And where we see a self.signal equals 2, so a sell signal, if we're already long, we close it, or if we don't already have a position, either way, we short self.sell with a size equivalent to 99% of our available capital. This part here allows you to put a time limit on your trades, so you could set a long trade, for example, with a 2% profit target and a 2% stop, and then say if you haven't reached either of those targets in 5 days, sell it anyway. So you keep that in if you want to do that. And then these parts here are parameters for the backtest. So we're telling it to take the OHLC data from DF. We're going to run the myStrat strategy class that we created above here. Starting cash is 100,000. Margin equals 1 means no leverage. Exclusive orders equals true means you can only have one position open at each time. Trade on close, true, we're going to get rid of, and hedging, true. We don't need hedging because we're only ever going to have one open trade, but trade on close. If you don't set that, the default is it will buy at the open following a buy or sell signal. And then we're paying commission here equivalent to 0.05% per side. So total fees would be 0.1% for a completed trade. That's a buy and a sell. And then finally, this little bit here, price. This is price as at the close of a buy or sell signal, and from that we're going to key for our stops. So our stop losses and our profit targets. So let's run it raw as we normally do first, so with no risk management whatsoever. So hit shift return here, and you can see it does really well. So so this is if you used it as a buy and hold strategy. If you were using it, I mean, it's kind of misleading, right? Because it's saying that you're an investor. So effectively, it doesn't ever trade the market. It flips short and gets long again following signals only. So, for example, you were short on this bar here until this signal came, and then you were long until this signal came. Okay, so effectively you'd be holding your trades all the time and then just flipping, long and short. And over the 10 years, you would have flipped 77 times. You win half of your trades, but you handsomely crush. The winners far outweigh the losers, and your drawdown's really good. And you beat the market handsomely, right? So really good strategy. But the misleading thing about that is that typically an investor is not going to flip short when you get a sell signal. It's typically just your trigger to get out of the market. So if you wanted to have a look at that instead, you would just comment out this line here. So when we get a sell signal now, if we've got a long position, we close it, but we're not actually going short. And if we just run that again, it still does really, really well. So you're in the market 83% of the time. You beat the market. You've got a drawdown lower than the drawdown the market would have given you. You're only buying 38% of the time. You good win rate, and your big and small sort of trade stats are good, right? So great little strategy, and you could use this as an investor. But obviously, you don't really have enough trades to be completely sure that this is a valid strategy. I don't like the idea of that anyway. So so what we're going to do is add some stops and profit targets in. So first of all, let's do the short side. So I'm going to comment out the buy side. So what's happening here is that if I get a buy signal and I'm already short, it will close it, but it just won't go long. So, and then let's add some targets for this. If I run it raw, by the way, makes 9% with nothing, which is really, really good for like a short strategy. But so that's basically you're getting short and then getting out of your short when a buy signal comes. So, but anyway, right. So let's add a little bit of risk management on here. So for this, I'm going to put a stop loss equivalent to 3% of the price as at the close of a buy or sell signal. And then I'm going to set a take profit target TP is equal to 5%, so that's 0.95% times that price. And if I just run that, you can see it does really, really well. So you're in the market 10% of the time, you make 34%, your drawdown is tiny, 39 trades. With a short strategy, I mean, just getting 50% of those right is really good. So we're not too bothered about the low win rate here. Our worst trade, because we've got stops in place, it's only 3.3%, and our best trade, probably due to a gap, would be 8%. So really good strategy, 34% made. And although that seems small, to a compounding return trading strategy, anything you can make on the short side adds pretty well, handsomely to your overall return when you add in the longs. So that's the short side. Let's now do the long side. And for this one, all we're going to do is a take profit target. Because the strategy seems relatively safe, he says, we're going to just add a take profit target, and that would be equal to 1.05 times price. So effectively a 5% stop, a 5% profit target based on the price at the close of a buy or sell signal. And then if I run that now, you can see in the market 77% of the time, so haven't massively reduced your risk, but you beat the market handsomely. You've got 115 trades, which is now enough to give you some statistical relevance. Obviously, the more you have, the best, but you can have a bit more confidence in your strategy than if it only had sort of 40 trades. Your win rate's good, 65%. Best trade, 16%. Worst trade, 8%. And the drawdown's far lower than the market actually gave you over the last 10 years. So a passive strategy, you beat that easily. So really good on the trading side, in my opinion, really good. But also you could use it on the investing side as well. And then if you notice one of the little anomaly here, so you can see your best trade here is 16%. So how can that be if we've got profit targets here at 5%? And the reason is because your profit targets are set on the close following that signal. So if I want to have a look at that, so this is all the data that you can pull out of your stats variable here. So what's displaying here is like your summary. But if you notice down at the bottom here, we've got trades, and you can get a list of your trades. And that's actually how we create the profit and loss graph. So we'll do that now. So if you think, I'm going to create a variable called trades, and that is going to be equal to our stats. And I'm going to take this trades function bit here. Right, there we go. So I'm going to take this bit here. So I'm going to go into my stats and isolate this data here and then save it in a parameter called trades. So if I want to have a look at what's in trades, just run that now. And what it's giving you is a list of all the trades that the strategy placed. So you've got your entry bar, but also your entry prices and what the stop losses and take profit targets were, as that the trade being opened, and then what your P&L is in monetary value, and also the return and percent value, duration, all the rest of it. So, okay, so you've got all that there. And what we're going to do is filter that data to look for our best trade. So we can have a look at that on the chart. So, yeah, so I'll create a new variable called best trade. And what I'm going to do is just sort the values in this trade list that you see before. And what I want it to filter for is this here. And there's a couple of ways you could do this, but return percentage, I'm going to get it to filter for that. So I'll take the return percentage, and what I'm going to do is sort it. So ascending equals false, which basically means put the highest value at the top. So that equals false, and then you could do it to filter for a specific value. So anything above 10% or anything above, that kind of thing. We could have done it that way, but this way is fine. And then from here, we're going to use the .ilot method and just return the first value. So that would be in this case 0. Put an O in there. So, and now if I want to have a look at what's in my best trade variable that I've just sorted from this data, you can see that so it entered at 167, but closed out at 195, and that's how we got our 16% return. So what we're looking for is bar 928, exit bar 945. Okay, so if I go and have a look at my chart now and just amend this to 900 and display the next 50 bars, what I'm looking for is probably, let's have a look what the prices are. Yeah, it's going to be that, isn't it? Okay, so I think this is the one here, the offending one. So you can see that we closed at 185.36, and 5% above that is the 194.95 target that we gave it. But we gapped down the next day to open at 167.83. So if we now go and have a look, yeah, there you go. So that's why, even though you've got profit targets at 5%, you end up with a 16% win. And that can go against you as well. So I'll leave this in here, so if you want to have a look at it. But next job then would be our profit and loss graph. And normally what you do to get that is create that trades list that we already created. So I don't need this line, but I'll take everything up to it. So let's do profit and loss. And I'm just going to paste that in. All we're doing now is creating a cumulative P&L. from our P&L data. If you remember, we had the actual profit, monetary value of wins or losses and that for each of those trades there. So what we're doing is taking the value in that column and creating the cumulative sum. And then Plotly's going to render this on a chart. The only bit I'm not going to have is this. If you want to save your chart image, keep that line in and run it. It'll save wherever you have your codebook stored. So, but effectively that's our P&L chart, and it's really good because I don't know if you spotted it, but the Q's had like a 40% drawdown 2021 into 2022, and this strategy just kept going, so trades really well in the downside, and that'll be our Ulcer index, I think, helping. And then not so good in the real rockety times higher. It can be a bit choppy, can't it? But once it got going, it avoided all the worst parts, definitely, and rocketed higher. Really good strategy. Pleased with that one. And then let's do a Monte Carlo simulation. So I'm just going to grab all this section here. Again, I don't need that trades one because I've already created that in the code above. So all this is doing is similar to the P&L graph. It's creating the cumulative return. So rather than looking at the monetary, win or loss values for each trade, it's taking the percent return, creating a cumulative return. And then this part's sort of the key bit. It's creating a loop that effectively randomizes the trade order, and it does it 100 times. And then for each of those randomized trade order, it creates an equity curve, and then it's displaying them all on one chart. So if I now get rid of that, I don't want to save the chart image. So if I now run that, you get a really nice bottom left to top right profile, pretty steep. But the key thing, what you want to see is all the lines to be together. You don't want a lot of variance. So what the Monte Carlo is designed to do is show you what would happen if all your losing trades came at the start. And in our case, our worst simulation, you were down 24% after 14 trades before it then started to get going. So overall, really safe, or it seems to be really safe. Could you use a bit of leverage? Maybe, but if you did, you would be wise to put a stop loss in, even if it's a loose one, but you'd be wise to put a stop loss on the buy side. So once you've got everything collared, then yeah, why not? But I'll add some in anyway because it's going to rip it higher. And don't forget, you get more on the investing side as well. But right, so if I did 2-to-1 here on the trading part of it, so and hit there, you would end up with close to 5,000% over that 10-year period. So really good strategy. Really like this one. And the thing I like about it the most is that it does well on the short side. So it actually makes money on the short side, decent. But it has done really well in the bear markets. So excellent. If you have any questions about this one or any others, email info@bubble-analytics.com. Otherwise, I'll leave you there and I'll see you next week. Thanks now. Bye-bye.